What is the state of global markets in the post-COVID-19 recovery? Are we really in a recovery phase, or is it something else? My name is David Ansara from the Center for Risk Analysis, and joining me today to discuss the state of global markets is Liston Meintjes, who's an investment advisor with Abercrombie Investment Management. Liston, welcome to the Center for Risk Analysis channel.
Good evening, David. Nice to be here.
So Liston, you focus in your work a lot on global markets. Could you give us your reading at the moment of global equity markets, other markets, bond markets, commodity markets too, if you like? And then also, since we're a South African channel, what extent do you think this is playing out in South Africa? How are markets looking domestically?
I think it's important to say to people that, we're all suffering from too much news. And in fact, a lot of that news is simply noise, and we miss the signal. So part of the game is actually to look at the longer term trends and avoid some of the short-term dramas. And we certainly have them of a daily basis, of a weekly basis, and of a monthly basis. And certainly when we talk of the year 2020, I think we're all going to remember it as one of high drama. But also, being the Center for Risk Analysis, I thought I should put in just a couple of points that I always like to make on what I call the aspects of risk. And in particular, I find in discussion, people talk about risk as though it is a single thing and an item. They very seldom define exactly what they mean. So I always say risk of what? And everybody has different risks and perceptions of risk. But to me, the item we're talking about in investments is the choice between the following two: the permanent loss of capital or a sudden dip. Now, if you have a sudden dip, the correct line, and most people will espouse it, is to see it through, because we tend to believe we will get back to a previous situation. Now, I firstly want to say that is not always true, because the world has changed. And if you were a buy and hold strategist and you bought energy as little ago as 10 years ago, you are now seriously underwater. So something like Shell and BP shares hit 25-year lows this week. Now that is incredible for if you've got a buy and hold strategy. So it does mean you have to take cognizance of what is going on in the world. And one of the risks there clearly are electric vehicles and climate change. And now those two are not necessarily directly related, but they both impact the risk that you're undertaking by investing in the old energy field. The second thing that I always like to quote this, and many people don't get it for the first time. We are told many, many times over, the higher the risk, the higher the return. And I have to tell anybody who's listening, that is 100% wrong. What is true is the higher the risk, the higher the risk. And what I'm really saying is the higher the risk, the higher needs to be the expected return, but with a reasonably high probability of occurrence. Now, that's quite important in what we're going to say about global equities going forward. So just the idea is we are trading risk for return. And by the way, we can't avoid risk. Our job is to manage risk. And certainly when you heard that there was COVID, and I was doing some consulting in Cape Town in February, we heard about COVID, and instantly people said, get more cash. Now that was before the fall. And the real question is, having got the cash, were they prepared to invest a second time or reinvest the money at and near the bottom? And the answer is yes. So fortunately, some people saw it coming, took a correct action.
So Liston, how does this play out in South Africa's markets?
Okay, let's move firstly back to the risk side of the story. We have a bond market which technically offers one of the highest stable rates of return for people seeking income. And it is true that because of South Africa's condition, we need foreigners to buy our bonds. but they haven't rushed for them. And part of that is because we are in a class of countries called emerging markets. And typically emerging markets are short of cash on their own. They need and depend on foreigners. And many of them over time have been in difficult situations. Now, I don't have to go into the full details. Every listener knows exactly what I'm saying when I say we have had any number of our own goals. My goodness me, whether you talk Eskom, whether you talk SAA, whether you talk just about anything related to government governance, foreigners take one look and say, I'd rather go somewhere else. So we've had to keep interest rates very high. If we can get a situation, and it may well develop yet, where the stability, A, of currency and B, of politics is sufficient, we should have lower interest rates. And that is an amazing spur to all kinds of economic activity. In the meantime, the economic activity in South Africa is incredibly low, always has been. Unemployment incredibly high. Inflation, for the first time in many, many years, is under control, reasonably tame. So would I buy a lot of South African consumer-facing companies? They've halved. Some of them are down 70%. And the answer is they do tend to look attractive. But there's a belief structure behind that saying, we think it is going to come right reasonably soon. I'm not sure that too many people with money actually believe that yet. So again, if you look worldwide, you will find that companies are using borrowings not to develop factories, not to expand their business, in one or two cases, maybe to buy another competitor who's in a bit of financial difficulties, but they're using it to buy their own shares back, which is an almost incredible situation. But if you are paying a 3% dividend and you can borrow money at 2% or less, it's a must do. It guarantees future improvement in earnings. So we don't have that in South Africa. So now, again, just coming back to the question as posed, we cannot talk about global equities or SA equities. The item is far too broad. Even if you look internationally, global equities, you will find that the technology, information technology particularly, is up about 28% for the year to date, and you will find the energy is down 50% year to date. That is an amazing swing, and yet they're both called equities, and what we look at is just the average or the index, and particularly that of the large market cap companies. So again, I always beg, don't ask me about equities, ask me a little bit more about which areas one might be interested in and why, and what is not happening. And so this is, in fact, the story of 2020. The COVID arrived and everybody said their markets will tank because the economies are going to tank. The economies have tanked. There's no doubt about that. Yes, they are staging some recovery. But the big point about that is that some of the equities have done incredibly well. And they have nearly all in areas that rely on the complexities that have happened. They happen to be large market cap company. So in fact, you will find that it's the large information technology shares that have done nearly all the heavy lifting so far. Can it continue? Not much more for them. Will it spill over into the next group? And the answer is, I personally doubt that it can do that in any reasonable time frame. So what I'm suggesting is that for international equities, we are likely to see a fairly lengthy period in which not much happens. How dull, how boring. And yet we have histories of that over many years, where following let's call it complexities in economies, markets just paddle sideways. So now let's just look at the post-COVID story. Yes, we got a quick bounce back because if you drop 40%, and you move up 20%, it sounds terrific. We're going up 20%. But actually, if you've only gone up 20% after falling 40, you aren't anywhere near where you were. So the story for me is that COVID is still in play. We can't talk about a post-COVID world yet. It may take a couple of years.
The Center for Risk Analysis, we focus on risk, but as you've pointed out, risk is an inextricable part of investment. And to what extent you're willing to take on that risk will determine your future performance. So we are not an investment advisory firm. We focus on strategic risk. But how should individual investors be looking at their portfolios going forward? Should they be looking to diversify internationally, to go offshore from South Africa? Do you think that the performance of the JSE warrants continued investment in the domestic market?
Well, again, if you look at our investable universe on the JSE, you will find that approximately 50% of it is offshore, either fully or a fairly major portion. So even staying local with a number of companies, you are getting that. I don't have to mention other than Naspers, Prosus, Richemont. So again, you can be offshore with investing on the JSE. And the real question is, it requires you to actually know and understand what it is that you're buying, why you're buying it. The idea of moving offshore, and the real question is, you hear that a lot of markets offshore are overpriced, expensive, and they point to price earnings multiple as too high. I'm not sure that you can make that analysis stick in a number of companies. And the reason I say that is because interest rates are so low. And what I'm really saying there is, yes, you have got your very high price earnings multiples, which skews the total for the average. But on the other side, you can find a number of companies, well-known names, producing items that are in demand, likely to remain in demand, may have suffered from a fall off in COVID, that are on price earnings multiples comparable with South Africa. Now, where you can find that, I certainly think that you should be doing the comparative and saying, I wonder whether it's better to buy, let's call it company X in South Africa on a 13 times price earnings multiple, or buying the other company offshore on a 14 price earnings multiple. In my opinion, and just doing various analyses on that, I would prefer most of my money to be in the offshore 14. Yes, it's a little bit more expensive, but it's not that much more expensive. So my only recommendation is, wherever people are considering these things, they need to know why they are doing it, and to be convinced that they will benefit, A, through the weakness of the rand, and more importantly, for the business case for that company. I can make no case whatsoever for buying bonds on a sub 2% interest rate. I just can't do it.
Liston, thank you very much for joining us all the way from New Zealand. We really appreciate you sharing your insights with us, and we hope to have you back on the channel in future.
Thank you.
That's all we have time for today from the Center for Risk Analysis. If you benefited from this video, please do give it a like. Remember to subscribe to the channel, and also check out the link below for our 30-day free trial to the CRA. Until next time, take care.